Farmers generally get the same depreciation tools as any other business. That means MACRS, Section 179 expensing, and bonus depreciation are all on the table. On the EA exam, the trap is thinking farmers are stuck with a special, slower method. They're not. The special part is mainly which class life applies and where you report a sale. Here's the big class life rule they love testing. New farm equipment and machinery placed in service is 5-year property under MACRS, thanks to TCJA. But used machinery and equipment generally stays 7-year property. So you have to ask one question first. Is it new to the taxpayer farm equipment or used? That answer changes the recovery period. Next, the method. Farmers may use the 200% declining balance method for farming assets, just like many other types of personal property. In older rules, you'll see farming property tied to 150% declining balance more often, but for exam purposes, know that 200% DB can apply. If a question asks which method is permitted, don't assume farmers are limited to 150%. Section 179 and bonus depreciation are both available to farmers, and qualified property can be new or used. That's another common exam twist. Bonus isn't just for brand new items in this context. If it's qualifying business property and placed in service, a farmer can potentially expense it under 179, take bonus, or use regular MACRS, depending on limits and elections. A weird but testable farm building rule. Greenhouses. A greenhouse used only to grow plants is single-purpose agricultural property, generally 10-year MACRS property. But if you add a sales function, like a cash register and kiosk, now it's not single-purpose anymore. On the EA exam, they'll change one fact and expect you to change the class life. Now switch to dispositions. Schedule F income does not include gains or losses from selling certain farm business assets. Think farmland, depreciable equipment, barns and other farm buildings, and livestock held for draft, breeding, sport, or dairy. Those sales are reported on Form 4797, and the result may be ordinary or capital depending on the asset and recapture rules. Form 4797 is your go-to form for sales of business property, including many farm dispositions. Exam tip. If you see Section 1231 gain from selling equipment, that's a Form 4797 item, not a Schedule C or Schedule F income line. It might later flow to other places, like Schedule D, but the reporting starts on Form 4797. Bianca owns a dog grooming business as a sole proprietor. During the year, she has gross receipts of $63,000. She pays $6,000 of wages, has supplies expense of $7,200 and utilities of $1,500. She also has a Section 1231 gain of $2,200 from selling equipment and makes a charitable contribution of $3,100. How much business income goes on Schedule C? Think about it. The correct answer is $48,300. Schedule C includes gross receipts minus ordinary and necessary business expenses. $63,000 minus $6,000 minus $7,200 minus $1,500. The tempting mistake is subtracting the charitable contribution or adding the Section 1231 gain. Charitable contributions aren't deducted on Schedule C, and the Section 1231 gain is reported on Form 4797. Which of the following is not Section 1245 property? Livestock held for breeding purposes, farming machinery, an office building, or computer equipment? Think about which items are personal property versus real property. Think about it. The correct answer is the office building. Section 1245 property is generally depreciable personal property, like equipment, machinery, and certain livestock used in the business. An office building is real property, typically Section 1250 property. The tempting wrong choice is livestock, but breeding livestock is treated like depreciable business property for these rules.